Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of InkResearch.ca, Canada's first online financial news and research service providing insider news and knowledge to investors. His website, CanadianInsider.com, home of the Canadian Insider Club. Welcome back to the show, Ted.
Jim, it's great to be back, and thanks for everybody tuning in.
Ted, oil prices have just gone crazy. Even Alberta Select Oil is over $100 US. What's the story there with energy?
Jim, we sent out our market update on Monday morning to our members, and we called it Oil, Batteries, Guns, and Gold, because I think those are some of the key themes that investors will be keeping an eye on in the months ahead, and oil's right at the top. Now, the question on everybody's mind, I think, is oil's blasted through $100. Can it, is this the top? And, there's so many factors that go into these types of situations where markets reverse. Unfortunately, they're never usually apparent until after the fact, even if they are then. So we just looked at the insiders for what they're telling us, and basically we're still seeing net buying in terms of companies with insider buying versus companies with insider selling. And this is remarkable given that the TSX Capped Energy Index is up well over 80% over the last 12 months. So it is very, very encouraging from an insider perspective when we see what they're doing, that we're not seeing the type of profit taking you might expect after such a wild run. And it also I think though has to be put into context that this is not going to be a straight line from here, even if that momentum continues that we've seen over the past few weeks. We do take the insider positioning as still being bullish, but I think that we're in a different world now. There was a report on CNN. Jill Doherty from CNN was interviewed someone from Moscow, or was talking to someone from Moscow, and this young girl from teenager, or I shouldn't give her age, but younger generation person is now describing life before the war and after the war, like before the Russia-Ukraine war, not World War II. Things have changed, and I think it's going to be a while for investors to get their head around it. Things had changed already after the pandemic, and there was this debate, as all your listeners are aware, transitory inflation or sticky inflation. Well, that debate is over, because now we have a new debate. What is the impact of the Russia-Ukraine war on the global economy? And so we're paying a close attention to what the insiders are doing right now, because we want to get a feel for, are they selling? Are they running for the hills in Canada? What are they doing? And initially, and this is a new war. It's only been on for a week. Initially, very early signals are in the energy space. We're continuing to see a constructive posture by energy insiders. And when you think about it, like the stock we wrote about on Thursday morning for our clients, we just looked at some of the valuations, and the valuations are still pretty much pricing in that this energy rally isn't sustainable, that energy stocks have come on a valuation basis, and when I mean valuation, I mean like PE ratios and price to cash ratios. those ratios have gone up, which makes them, more expensive. But still, in general, the energy sector is still, the average valuation in the energy sector is it is below the market average. It used to be well below. It has come in a bit. But, for example, based off of our data, the entire energy sector is trading at a price to cash ratio of about 7.1 versus a market average of 10. PE 13.4 versus 15.4 for the whole market. Now, that 13.4 has come up quite a bit since a year ago. After all, the sector has had a nice rally here, but it's not trading on average above the market. And look, this is where the action is, all the chickens are coming home. All the environmental green chickens are coming home to roost now. Where we had this mantra for a decade that, oh no, we have to keep the oil in the ground, especially in North America and in Canada. We can't possibly, export our oil via pipeline, at least if, on an ambitious basis. I understand there's a pipeline that's trying to get built from Alberta to Vancouver. It's called the Trans Mountain Pipeline expansion. That is still under construction and well over budget. And I expect they'll finish it, but it's not finished. And, we've been dragging our feet, and all that time, what have we been doing is we've been dragging our feet and giving so much space, and it's not just Canada, but it's also the United States, and Europe even more, giving this environmentalist narrative room, while they've given Russia lots of geopolitical leverage. And I'm sorry, those are just the facts. You see them unfolding in Europe. It's costing lives. All this green mantra to keep Canadian oil in the ground and to keep, to move away from, producing fossil fuels in North America. That's now we're paying a heavy price. The Western democracies are paying a heavy price for that wrong-footed approach to the energy transition. I've been on this show for years now talking about, yes, let's work to a lower carbon environment, but you're not going to do it by shutting down the North American oil patch. Like, that's just nuts. And now we're seeing the results of, giving in to this environmental narrative that we should be cutting back on our production and letting bad actors come in, and which is, they don't want to hear about that. You engage any of the environmental, lobby on that, on social media, and you just don't, you just get denials and trying to change the subject and, saying, well, we have to set an example or whatever. But the reality is, now look where we are. And where we are is not a pretty sight. You just have to turn on TV and we see it. So, in terms of the investing environment, though, we have, I believe, because you see these relative valuations of the energy sector still below the general average, the average investor doesn't think this is going to last for very long. And, there's still a huge section of the investing public, and I'm not talking about retail here. I'm talking about institutional, other people's money, professional managers, CFAs, who many CFAs have and never lived through a true inflationary environment, don't remember anything about the guns and butter period of the Johnson era, never had to worry about, stagflation. Well, it's here, folks. That's what we got yet, and I haven't been seeing a lot of pushback on that on social media, but it wasn't that long ago where you would have people saying, no, it's not stagflation, this is just transitory. Oh, no, it's Goldilocks, right? There's no Goldilocks. Goldilocks has been blown apart, right? There is no Goldilocks. There's no Goldilocks, right? Forget that. Her era is gone, right? So what are we faced with? Well, we're faced with a new kind of stagflationary era. And what does that mean for investing opportunities? Well, for the Canadian oil patch, it's looking, I think, pretty good. Now, this, unfortunately, does not mean, again, it's going to be a linear move up. There's going to be lots of pullbacks. And, for those who trade crypto, that may not be such, a strange occurrence. But, for those who've been used to sort of the Fed smoothing out volatility for the past, decade, yes, and once in a while you have these air pockets down, when COVID happens, or the Fed makes a really bad mistake like they did in 2018, or mistake, let's call it a, mistake, they tightened too much. Yeah, then you go for these spills. But this is something now that the Fed cannot control. In 2018, if you remember, Jim, the market went for a real tank on Christmas Eve, and the Fed had to reverse course, and they were able to right-size the market by saying, "Oh no, we're not gonna raise rates anymore. We're stopping that," and the market stabilized. Well, the Fed's talking about raising a quarter point here, quarter point there. That's nothing in the grand scheme of things. When you have this kind of inflation, you're going to raise rates quarter point. It's not going to stop a hoarding that goes on during a war economy, right? It's going to would take significantly higher interest rates to start to put a dent in countries and big companies wanting to hoard oil. So we're nowhere near the Fed getting, in my opinion, getting on top of the inflation dynamic, because this is now this war. When I was on your show a month ago, I don't know if we talked about Russia, Ukraine, but it certainly wasn't the major focus of the conversation, right? So this is a non-controllable Fed event, and it's just not going to. They're just not going to be able to deal with it. So investors are left on their own. It's going to be a lot tougher environment to make money. Yes, we're bullish on the energy sector. No, it doesn't mean oil's going to keep marching up and up and up, and share prices are going to up and up. It means we're going to have a lot of volatility. We're going to have strategic petroleum releases. We're going to have talks of ceasefire. We're going to have, maybe we'll have some ceasefires. We're going to have, warmer weather. All these things are going to send the oil and gas stocks up and down, and there's going to be dips, and unfortunately, it's going to be a very volatile environment. And while we believe that over the 6 to 12 months, the momentum is still with the energy sector, we have had a nice run here, so there's going to be corrections. But look, just stick with the insiders, see what companies they're buying. Doesn't mean those ones are going to go up, but it's not a bad starting point to start looking and assessing whether that's a company worth looking at. And that's what we're doing. And it's worked out very well for our members over the past year, and we're going to keep relying on that. And if we start seeing profit taking en masse in the energy sector, we'll see what the conditions are in the market at that time, and we'll be able to put two and two together. So at this point, it looks like momentum remains with the sector. We started the year off on this show talking about the oil and gas sector being one of the best areas that we saw in the market in terms of insider sentiment. And at this point, we're continuing to see signals that the momentum is going to continue over the next year or so. But let's strap on our seatbelts. It's going to be a rough ride. That's our take on things for sure.
We'll have more with Ted Dixon right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Continuing on with your headline, oil, batteries, guns, and gold, what's going on with batteries?
Well, that gets into the strategic metals part of the market, which hasn't really caught a bid lately. And some of them have come off quite a bit. Really, Jim, a year ago, not everything, but a lot of sectors and industries in the market were on fire. I mean, a year ago we were probably talking about GameStop. A year ago, Bitcoin transactions were much higher than they are now, and Bitcoin was making new highs. But not just making new highs, but on a high volume. We had junior mining was, starting, and silver mine, gold mine juniors and silver juniors, there was life in there. It all kind of peaked in early March, and, since then it's been a tough slog for a lot of those areas. Now, again, that was before the war. Now we're in the war, and I got to think that the other people's money crowd are going to have to deploy their capital a lot more astutely than they've been deploying it before. Before, it would be like, do you buy Cathie Wood stocks or do you buy value stocks, right? Am I going to tilt into energy or this, maybe automaker with a low PE, or am I going to buy, stay at home, high price PE stocks that are, that are priced in, they're pricing in years of stay at home economy. So that choice is too simple when you've got this major type of conflict going on, geopolitical struggles that are impacting real businesses via sanctions, via things getting broken, via a big growth in demand for defense equipment, right? This is a new environment, and it's very new. And so when you look at what's happening in the battery metals, where is the number one rare earth supplier in the world? It's China. Well, where does China fit in all of this? Well, unfortunately, China is basically, and India, which together represent more than a third of the world's population, they sat out the vote on the UN condemning the Russian invasion of Ukraine. So, there is a lot of tension, and there's a lot going on under the surface that is going to have an impact on the markets. And it doesn't mean stocks cannot climb the wall of worry, but in terms of which areas of the market are going to excel, we have our eye on certain rare earth, battery metals type plays, and I think that anything that's sort of strategic may finally come into get a bid. If it doesn't get a bid now, if it doesn't start to turn around now, if not now, when? I think we have to ask ourselves that. And are the Western economies going to be happy having their supply chain so dependent on China, given how China has been exposed as sort of not willing to vigorously condemn Russia for its moves into the Ukraine. So I'm not saying that as a political statement. I'm saying that as sort of as a reality in terms of how the geopolitical realities are shaping up. We appear to be having two blocks formed, at least two blocks, not necessarily like back in the Cold War days where you had the West and the East, but you've got the dollar block that's able to use the SWIFT system. I call them the Western democracy bloc. And then you've got the, I guess for lack of another, we'll call it the, quasi-authoritarian bloc, because some countries involved with that, I wouldn't go as far as to call them authoritarian, but certainly not aligned with the Western democracies. It's more of a fuzzy group of Russia, China. Surprisingly, India is making some odd statements about helping Russia basically avoid sanctions using a rupee trade facility. So there are some developments that are, we'll have to see how these pan out. But these are going to have impacts on companies, and they already are. So that's why stock selection is really going to be key. And even if you get the right theme, even if, let's say I'm right on the battery metals and in rare earths, it does start to take off. Well, it doesn't mean every stock in the group will, because some stocks are tied deeply into China and others are not. Others are not reliant on China. And you could have vast differences in performance between the two. So, and you look at the gold sector even, where the gold mine's located, that's a big issue. So it's, where these companies are operating, where their customer base is, where their expertise is, this is going to be a very important stock pickers market. And so it's great for investment advisors who are active in playing a role in designing client portfolios. It may not be so good for investment advisors who are strictly asset gatherers, who leave it up to models to pick ETFs. Just the point being is that stock selection is really going to matter here, and there's going to be an opportunity, but it's going to be really tough. It's let's not kid ourselves. It's going to be really tough to pick the winners, tougher than usual, because it's not just going to be the PEs and the valuation models. Because it's going to be where are the cash flows coming from, how secure are those cash flows, where's the supply, where's the supply chain. There's so many factors involved with that. And the nice thing about using the insiders is that, they kind of understand what's going on in their own industry. And if they sniff trouble, they may be more inclined to take profit. So, there's never been, I think, a more important time to follow the insiders in terms of, what they're doing with their own stock. And, so far, it's worked really well for us in the oil patch. We're hoping it's going to, also give us some ideas of what to do in the mining area. We've already, I mentioned the battery metals because there's one name in particular that we've written about that that's come off its highs, and we saw some insider activity there, and they don't have exposure to China. So, there's going to be a lot of different examples, I think, where you can find some spots that will potentially excel in this environment. I say potentially because the environment can change in any few minutes. But we're in. This is not life before the war. This is life during wartime and investing during wartime. So it's a brand new environment. And fortunately, we have the Canadian oil patch, which is looking really good. So we have this base of opportunity in Canada, and I see this as like a core investing opportunity. The oil patch, you can that to us, like right now, our Canadian Insider Index, which is a rules-based index. I don't sit there and pick the names. It's determined by a quantitative filtering system, and it's 45% energy. That's like the highest. That may even be an all-time high. It was super high back in the 2006, 2007, but I don't know if it's ever gotten this high. And the market structure in Canada has changed, but energy is certainly a core area in Canada. We have to be very, very thankful as investors that we have that to invest around. There'll be times to move in it, times to move out of it, but let's take our let's be thankful for like those types of situations when we get them. And, in that sense, we're very fortunate to be investing around this conflict, via with a home base in the Canadian market, because we can see what's going on. And so from that perspective, it's a positive for Canadian investors that we can drill down into these oil patch names. We can look at these mining companies that may be of strategic value to Western economies, Western democratic economies, and we can identify those. Whereas, even the bigger markets like the U.S. market, I think investors have been so focused on the past winners, which is natural, but that was before the war, and now we've got to deal with the conflict and the impact on global economy, supply chains, and what's going to be in short supply, and that gold can help as well in terms of being a hedge against that. And again, being in Canada, we're able to get a quick look, we know where to look in terms of what gold companies, are they promising or are they not promising? We rank gold companies with our Ink Edge process. We get a very quick take as to what's on our short list and what's not. And for those investors who have never looked at gold, like they're just starting out, like they don't even know where to begin. You know where they begin, Jim? They begin at Newmont because Newmont's the biggest one in the U.S., right? So that's fine. But we have our. Let's just put it this way: Newmont would not be the top stock on our gold list to look at. Like it just wouldn't. But you're going to have a number of investors who are going to be. I don't want to say panicking into the sector, but who've never invested seriously, so they'll buy the ETF, and they'll they won't really know what to do. So in Canada, we have that advantage that we know this. Many investors know that sector well, but now is the time to really kind of sharpen our pencils and drill down and find out where the ones are well positioned to deliver for investors. Which have the assets in the right places, which have the management teams that have demonstrated that they do care about their shareholders and adding value. I mean, this is now the time where I think we can put all that knowledge to work in Canada, and we can build there should be an opportunity now to really exploit all that knowledge we have in the mining area and the oil and gas area, during some very, very tough times. Now, look, I just want to say one thing. In terms of the U.S. market, look, it could keep grinding higher a bit here. It wouldn't also surprise me if it just sort of goes nowhere for 5 years. It goes up, then it corrects back up and corrects. Or it could trend a bit higher because the Fed is so far behind the curve, and inflation could help the top lines of many companies. We will see. But in terms of where the real action is going to be for the next few years, I mean, I'm quite happy to be looking at Canadian stocks, and it's been a good ride in the oil patch, and let's see how the gold group does, because I think that gold's behaving very well here. It's not kind of making huge moves to the upside that are going to necessarily have to close a gap or anything like that. So it's behaving quite well. So it's looking. I'm more constructive on the gold group now than I have been in many, many years. So I've been building my kind of bullish attitude towards them over the past sort of 6 months or so. It's been like every gold investor, it's been a waiting game. But now's not the time I'd be looking to sell the rallies in gold. I'd be waiting for the dips as opportunities. So and I think you're going to see that thinking evolve throughout the market. And I just don't know where a lot of these professional managed funds are going to go in the U.S. now in this environment. They're going to be scrambling, but it's going to take some time. So I don't expect a huge melt up in mining shares, but I think there's an opportunity now that one can have a little bit more confidence towards the prospects for the group.
Ted, thank you so much for chatting with us.
Jim, thanks for having me back.
My guest has been Ted Dixon, CEO and co-founder of IncResearch.ca, his website, CanadianInsider.com. If you have any questions for Ted or any of our other guests, you can send them to info@HowStreet.com, our YouTube channel, Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.